Welcoming on board Mr. Vivek Karve, the CFO at Mahindra Finance, joining us. Of course, the monthly update from Mahindra Finance was out. It was a healthy disbursement trend that we saw. Collection efficiency also continues to be robust. So, a largely inline set of numbers coming in, and that's the reason the stock is holding up with a gain of almost 1%. Vivek, hi, thanks so much for making time and speaking with us. I was going through your disbursement numbers, and it's again a very healthy set that has come in so far. Is it fair to assume that the quarterly run rate will continue to be around the 13,000 crore mark for Q2 FY24?
Hi, first of all, good morning to all the viewers, and thank you for having me today on the call. While I will not be able to give a very specific quarterly guidance, what we are quite confident about is about continuing of the momentum. So, for example, in the month that just got over, the disbursement were up 15%, and as a result of which the AUM on a YOY basis has grown 27%. So taking the viewers back to the medium-term game plan that we had talked about at the beginning of FY23, we said that we would like to double our AUM over a 3-year period. And I believe we are on track to make that objective come true.
Looking at a specific number from you, Vivek, but just wanted to get a sense in terms of the pre-festive demand. How's the momentum being? Because the last time we had the conversation, you were talking about how the pre-owned vehicle segment is doing quite well. The rural sentiment was showing quite a bit of uptick. Is it getting incrementally better from there?
Yeah, so if you look at the dealer inventories, the dealers have also been stocking up in order to meet the festival demand, which will start in the early third quarter, I would say. So we believe the dealers are adequately stocked up. We also support the dealers with the trade advance facility, which also is at a healthy level. So I believe the momentum will continue, and as and when the dealers do the retail, we should be able to get a fair share of them.
Early indications are showing that there is very little comeback in the rural economy. Could that pour cold water on all the assumptions? Because when I speak to car companies, they're excited about festival season demand. When I speak to NBFCs, they feel that dealer financing this time will be strong, trade financing will be strong. But the on-ground evidence keeps on telling me something very, very different.
So if you look at the infrastructure spends by the government and the overall macro indicators in the economy, despite the fact that monsoon so far has not played out exactly the way we wanted it to, I believe the demand momentum has continued. And insofar as there is momentum in the economy, the customers who invest in the vehicles because they earn out of those vehicles, they will look for financing. And to that extent, except for a few nervous moments which are more instigated by suboptimal monsoon, I believe the momentum will continue.
Every report I read talks about one thing, that when will the change on ROE and ROA will actually structurally start for Mahindra and Mahindra. You're working on it, but when do we see real evidence of you hitting that sweet growth curve?
Okay, so you will recollect that last fiscal in FY23, we had reported 2.3% post-tax ROA, which led to, I would say, a reasonably good ROE of 12%. And in our medium-term game plan, we have talked about reaching the milestone of 2.5% post-tax ROA, which with the growth in the AUM will also lead us to a 15% ROE. And this is a dream that we had talked about by end of FY25. We stay committed to that.
Okay. In order to achieve that, you will have to start moving from the low yielding loans to high yielding loans. Now we are looking at the landscape getting very competitive. We are looking at cost to income ratios changing. So for you to migrate from low yielding loans to high yielding loans, how will you achieve that?
Okay, so end of the day, it is not about low yielding or high yielding. It is about delivering that post-tax ROA of 2.5%. So what are we doing? So we are building a judicious mix of probably lower yielding but extremely high quality assets, and creating a mix of pre-owned vehicle financing. With that, what we will achieve is that we will try to balance the yields. At the same time, we'll try to manage the overall volatility on the balance sheet and also meet the target on overall credit cost and post-tax ROA. So just to repeat, it is not just about moving from low yielding to high yielding. It is more about improving the mix such that we are able to gain that sweet spot of a reasonably good yield and a reasonably healthy post-tax ROA.
Okay. And what about the outlook then when it comes to your net interest margins? Because I understand that you see your blended NIMs at about 7.1% by the end of this year. Does that guidance change given that there is now a stronger possibility of rates being higher for longer?
So if you recollect last year, full year, our NIMs were 7.4%. However, in the first quarter, the NIMs were 6.8%. That was primarily because of anniversarization of the borrowing cost. And as the outlook suggests, we are not expecting any further decline in the interest rate cycle either. However, we are also not expecting a significant increase in the interest rate cycle. So our attempt will be to reach closer to the 7% mark for the full year as we close the year FY24.
All right. Thank you for sharing with us all those growth targets as well as the outlook on M&M Finance.